I really don't think it's possible that you could have a more exciting and potentially volatile market ahead. This is because you have quad witching on June 16th. You have Fed Jerome Powell on Wednesday. You're going to get CPI data, PPI data. You're going to get retail sales this week as well as initial jobless claims. Not to mention, we have bad news over this weekend that could put a negative bias on the markets. Now, how does quad witching typically affect our markets? And what are some of the biggest things you need to know heading into this week? Specifically with the broad markets, but as well as other sectors such as the EV sector and Tesla. This week's going to have massive implications for certain sectors as well specifically. So let's get into all of this information. Hit that like button and subscribe to the channel and source your comments, questions, or concerns down below in the comment section if you want to stay up to date with all of this information. And if you want to grow your net worth, become financially free as soon as possible, you need to hear this information. Now let's talk about the quad witching day that's going to be this Friday. Now I'm sure you guys have heard of this before, but if you don't remember what it is or what importance it can have to the markets, let me give you a refresher. So it's essentially when index futures, stock index options, stock options, and single stock futures expire at the same time on the same day. 4 different asset classes or derivative classes. Sometimes you get triple witching days as well, and that's just when one less of these expire, right? When you have one out of the mix that doesn't have an option expiration on that given week. Now, a lot of people tend to think that quad witching weeks lead to more volatility, and the data just doesn't support that. Although some weeks, some quad witching, weeks can be bigger moves, it's not a definitive. And you really shouldn't feel any specific way about this, but I will tell you on stocks that have rallied leading into quad witching weeks or stocks that have dropped heading into quad witching expirations, you can see bigger moves in that direction. That's because people start to get assigned on options. And if you have a big skew towards calls or puts, that last hour of the trading day on Friday can give you a bigger move than your average day. That's one definitive that you could draw from a quad witching week. Now, take this into consideration as we go through the rest of this video. So on Monday, you're going to have probably the most impactful catalyst, and this is going to be a tranche of bond auctions. Now, the Treasury had to deplete their TGA account, their Treasury General account. They plan to sell about 1.5 trillion worth of bonds in 2023, and you only have 6 months left of 2023. So you're going to see a lot of bonds get dumped on this market, and that will have a material effect on our markets. It will pull out capital from the stock market, from theoretically real estate, from derivatives markets, from fixed income, from a lot of different places. And on Monday, you're going to have a 6-month bond auction, a 3-year bond auction, a 3-month bond auction, and a 10-year bond auction. All of these happen in between 11 and 1 p.m. on Monday. Now, you're also going to get consumer inflation expectations for the month of May. This will be very important. This will come out at 11 o'clock in the morning. You're expecting 4.2%. Last month's reading was 4.4%. If this goes higher, that's a problem. That would lead to inflation expectations becoming unanchored. And what we've seen recently is actually inflation expectations have been going higher, and you're at the highest levels of inflation expectations on a 1-year, a 5-year, and a 10-year forward outlook that you have been throughout this whole entire rate hike cycle, which after rates have went from 0 to 5.25% or 5%, that shouldn't be happening. Now, on Tuesday is when things kick into high gear for the markets, because you're going to get inflation data coming in at 8:30 in the morning. The headline month over month is expected to come in at 0.3%. Last month, it was at 0.4%. So you're expecting a deceleration. This would be 3.6% on a month over month forward looking basis. That would be positive. 0.4%, you're at 4.6% or 4.8%. That's not as positive. So you definitely want to see this number coming down. Now, the core inflation rate year over year, you're expecting that to come in at 5.4%. Last month's reading was 5.5%. So a slight deceleration there as well would be another welcome sign if that did happen. Now, headline inflation month or year over year, you're expecting that to come in at 4.3%. Last month's reading was 4.9%. So you're expecting the headline to basically fall like a rock this week. And the core inflation rate month over month, you're expecting that to tick down to 0.3%. Last month's reading was 0.4%. Now, it's interesting because last inflation data we got, you actually seen the month over month accelerate and the year over year fell like a rock. So I was under the impression last time around that the month over month, the current inflation rate would be more important than the year over year, right? When you look back at last year, I thought current data would be more important. It was not. Markets absolutely ripped on the last inflation report. So I want to say the year over year numbers here are going to be a little bit more important. But if those month over month numbers are bad, that's still going to be very negative for the market. So I don't necessarily have a strong opinion on how these numbers are going to come out. It doesn't look like or feel like we have seen much progress with inflation. And to be quite frank, it looks like there's more inflationary pressures now than where we were sitting at the end of 2022. It seems like you were seeing less inflation pressures. So we'll see. Kind of have an upside bias there. I do think inflation's probably going to come in hotter than these expectations. They're pricing in a pretty rosy picture, especially on those headline year over year declines from 4.9% to 4.1%. That is a very, respectful decline that markets are expecting. And that is on the consensus view for the headline year over year. Now, the next day, on Wednesday, you're going to get the Fed meeting. Now, this is going to be a major catalyst for this market, a huge catalyst. And that's because markets right now are pricing in weird things for the Fed policy. You have not seen markets so disconnected on what Fed policy is going to be over the next coming months in a long time. So for June 14th, for this week, for Wednesday, you're expecting the Fed to pause. Now, the probability of this currently is 70%. If inflation comes in hotter than expectations, this probability is going to go over 50%, and the Fed will do whatever is priced in over 50% on this chart. Make sure you guys have this on your computer or handy on your phone come Tuesday. This will drive the movement of the markets. If inflation is too hot on Tuesday, markets are going to price a Fed rate hike the next day on Wednesday. You're not going to have a lot of time to react to this. And the sooner you get that information, the more money that you might be able to make. But if we look ahead, currently, now this could change on Tuesday, and it will change on Tuesday, so be prepared for that. But currently, for the July 26th meeting, you're expecting the Fed to raise rates by almost 53% odds. In September, you're expecting the Fed to hold, right, to raise in July and then hold those rates in between 5.25% and 5.5% by a 50% probability. And then coming November, you're pricing in a 39% chance, the highest likelihood, that the Fed will be cutting once. 125 basis point cut. And then in December, you're expecting the Fed to pause again. And then coming January 31st, 2024, you're expecting the Fed to cut rates one more time. So you're expecting a pause, a hike, a pause, and a cut. That is not typically how the Fed operates. Now, that is nowhere close to what the Fed has said themselves that they plan to do. So you're probably going to get a hawkish Fed this week. be fully prepared for that. Markets, ultimately, they're going to worry more about a recession than they do the Fed. As long as inflation does come down, I wouldn't be so worried with what the Fed has to say. But if inflation does not come down, well, what the Fed says is going to have a much greater bearish impact on our markets, in my personal opinion. Could be wrong there. I'm not a financial advisor. I'm not a financial planner. Always come to your own conclusions. But that's my interpretation of this week. Now, if we look back at the economic calendar and look at Thursday, or even Wednesday, actually, I actually missed this. You're going to have PPI month over month, and this is before the Fed on Wednesday. You're expecting this to come in at 0.1%. Last month's reading was 0.2%. Some people are forecasting this to come in at negative 0.1%. This is the producer side of inflation, expecting another move down. So still some pretty rosy expectations from inflation data. Now, coming on Thursday, retail sales could be very important. Now, retail sales for the month of May come out 8:30 in the morning on Thursday. You're expecting this to come in at 0.2%, so still in positive territory, and it's been a lot of back and forth recently with retail sales. You could see the tan is negative, the blue is in the positive. It's been very back and forth. Recessionary data overall. Last month's reading was positive 0.4%. So you are expecting a slowdown here. Some people are forecasting this could go negative again by 0.1%. Now, as well on Thursday, coming in at 8:30 in the morning, also like retail sales, Philly Fed Manufacturing Index, New York Empire State Manufacturing Index, initial jobless claims, Philly Fed new orders, Philly Fed CapEx, Philly Fed prices paid, Philly Fed business conditions, Philly Fed employment. You get the idea. A lot of Fed districts are going to give you a data dump on how their specific districts are doing. And some of these data points can have implications for inflation, for economic activity, for a recession or not. Now, don't think the fun ends there, because on Friday, you're going to get the third most important catalyst, in my personal opinion. Right behind inflation as the number one, the Fed as the number two, it's the Michigan Consumer Sentiment. You get the preliminary survey for June. Now, what's specifically important here is the 5-year inflation expectations. If we pull up this chart on 5-year inflation expectations, they have started to rise. You were at 3.1% for 5-year inflation expectations. This is the highest level that you have been at in over 5 years, in over 10 years. 25 years, last time you were here was right before the crash in 2008, and it was at 3.4%. And you're at 3.1% right now. So if this does start to shoot higher, as it has done since the bottom of the markets in October, which was this right here, if it goes higher again, call it 3.3%, 3.4%, you're going to get the markets that start to consider if inflation expectation is becoming unanchored. It would be the 4th month in a row of inflation expectations rising on a 5-year basis. Markets don't care as much, the Fed don't care as much about 1-year inflation expectations. And you're also going to get that data as well coming in with this report, but those 5 years are going to be important. Now, the Michigan Consumer Sentiment headline number is expected to come in at 60.8. Last month's reading was 59.2. Expecting consumer sentiment to get better again from May to June. Now, Michigan current conditions expected that at 64. Last month was 64.9, so getting better again. And then Michigan consumer expectations at 56. Last month's rating was 55.4. So the data here is trying to support the Fed pause right now. Markets are priced for perfection with this economic data. As far as pricing inflation to come down, retail sales to fall, but not enough to give you recession fears. For producer price inflation, that's what I like to call it. It's PPI, Producer Price Index. We're expecting producer inflation to fall as well and go into potentially negative territory. And we're expecting the consumer sentiment numbers to improve. This would be supporting the Fed pause. If these data points don't exactly align with what we're currently pricing in, probably going to mean some downside, considering stocks have rallied very aggressively in the last couple of weeks. Now, if you also want to consider that the breadth of this market has been very narrow, your Magnificent Seven, your big tech names, have done all of the carrying of the indexes. The indexes on an equal weighted basis are essentially flat for 2023. So markets have really not done much under the surface. And actually, your small and mid cap stocks are quite negative so far in 2023. And you can see the breadth by the look of this chart. Theoretically, these lines should look pretty similar, and they really don't. And to the extent that they don't, is one of the worst market breadths that you have seen in a very long time. Even though you have seen a recovery in breadth recently, it's still being really led, or I should say the markets are still really being led by these big tech names. So considering Fed Powell and inflation and recession have such an impact on these big tech names, specifically interest rates, that's why this week's going to be that much more volatile. When you also consider quad witching and how these stocks have rallied by quite a bit, if you see rolling over of some option positions, if you see exercising of a lot of calls or puts and so on and so forth, a lot of derivative activity, it could make the moves that much larger with big tech, which will affect the broad indexes. As you know, the S&P 500 closed on Friday at a higher level than you've seen since June of 2022. You're pricing in a lot of good news. Some would say you're pricing in near perfection. And that's not necessarily the market that I want to be super bullish in. Now, specific sectors could benefit a lot more, in which we'll talk about in the next video. Stocks such as Tesla might have a big benefit to be had in this upcoming week. Make sure to click on the next video down here to watch that for yourselves. That's going to do it here in this video. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Thank you for watching, and I will see you in the next one.